400 points. That's how much wealth evaporated from Japan's stock market before most Tokyo workers had finished their morning coffee. And one man saw it coming. We'll call him Tanaka-san. He's a 52-year-old day trader who's spent the last 20 years watching numbers flicker across his screens in a modest office in Nyanbashi, Tokyo's historic financial district. Every Sunday night, while his family sleeps, Tanaka-san does something most casual investors never think to do. He reads, not stock charts, not earnings reports. He reads international news, diplomatic cables, energy analysis. And this particular Sunday, the headlines made his stomach drop. The United States and Iran had just walked away from nuclear talks in Oman with nothing to show for it. No deal, no progress, just mutual frustration and the same uncertainty that had been hanging over global oil markets for months. By the time Monday morning arrived, Tanaka-san had already positioned his portfolio for what he knew was coming. But here's the thing. Most Japanese investors had no idea that events unfolding thousands of miles away in the Middle East were about to hit their retirement accounts directly. In this video, you're going to learn exactly how a failed diplomatic meeting in Oman crashed Tokyo's stock market, why oil supply fears trigger panic selling faster in Japan than almost anywhere else, and what experienced traders like Tanaka-san do differently when global headlines turn ugly. 9 o'clock Monday morning. The opening bell at the Tokyo Stock Exchange hasn't even finished ringing when the sell orders start flooding in. Tanaka-san watches his screen as stock after stock turns red. Toyota, down. Sony, down. Mitsubishi Heavy Industries, down harder. SoftBank, plummeting. The Nikkei 225, Japan's benchmark index, begins its 400-point descent like a plane losing altitude. And it's not just the big names. Smaller companies, regional banks, shipping firms, nearly every sector is bleeding. Here's what makes this particular crash so frustrating for ordinary Japanese investors. Most of them went to bed Sunday night feeling pretty good about their portfolios. The previous week had ended on an optimistic note. Economic data looked reasonable. Corporate earnings were holding steady. Nothing in the domestic Japanese economy suggested that Monday would be a disaster. But the stock market doesn't care about last week. It cares about tomorrow. And tomorrow suddenly looked very uncertain because of events that had nothing to do with Japan directly. Tanaka-san's phone starts buzzing. Messages from friends asking what's happening. Family members wondering if they should sell everything. A younger colleague panicking about his first major market downer. This is the problem with being a Japanese investor in a globally connected economy. Your financial future can change overnight based on a conversation between diplomats in a country most people couldn't find on a map. Here's what most people don't understand about Japan's economy. This island nation imports roughly 90% of its oil. 90%. Almost every drop of fuel that powers Japanese factories, heats Japanese homes, and moves Japanese cars comes from somewhere else. And a huge portion of that oil flows through one of the most strategically vulnerable choke points on the planet. The Strait of Hormuz. That narrow passage between Iran and the Arabian Peninsula sees roughly 20% of the world's oil supply pass through it every single day. When U.S.-Iran relations deteriorate, that choke point becomes a pressure point. And Japan feels the squeeze more than almost any other developed economy. This is the hidden cause behind Monday's crash. It wasn't really about stock valuations or corporate earnings or interest rates. It was about energy security. When the weekend talks between Washington and Tehran collapsed without an agreement, oil traders immediately started pricing in continued uncertainty. Would there be new sanctions? Could Iran restrict tanker traffic? Might regional tensions escalate into something worse? These questions might seem distant and abstract to a Tokyo office worker checking their investment app on the train. But to the algorithms and professional traders who move billions of dollars in milliseconds, they're not abstract at all. They're immediate threats to the fundamental cost structure of every Japanese company that uses energy, which is essentially all of them. Here's where this story stops being about one trader and starts being about you. Because what happened to Japanese investors on that Monday morning happens to investors everywhere, all the time. You wake up, you check your phone, and suddenly your portfolio is worth less than it was yesterday for reasons that seem completely disconnected from your actual life. A war breaks out somewhere. A politician says something unexpected. A central bank changes a number. And somehow, money that you worked hard to save just vanishes into thin air. This pattern is especially common for retail investors in Japan. Unlike some Western countries where professional fund managers dominate the market, Japan has one of the highest rates of individual stock ownership in the developed world. Roughly 54% of Japanese households own stocks directly or through investment trusts. These aren't Wall Street professionals with sophisticated hedging strategies. They're ordinary people, salary workers, small business owners, retirees, trying to grow their savings in an era of near-zero interest rates. And when geopolitical shocks hit, they're often the last to react and the first to panic. Tanaka-san has watched this pattern repeat for 2 decades. Every few months, some external shock crashes through the market. Retail investors sell at the bottom. Prices recover. And then the same people buy back in at higher prices, locking in their losses. It's a cycle that transfers wealth from nervous amateurs to patient professionals. And it happens because most people never learn what actually drives market movements. Back in Tanaka-san's office, something interesting is happening. While everyone around him is selling, he's doing the opposite. He's buying. Not recklessly. Not everything. But carefully selected positions in companies he's been watching for months, waiting for exactly this kind of irrational sell-off. This is the turning point that separates experienced investors from emotional ones. Tanaka-san learned this lesson the hard way during the 2008 financial crisis. Back then, he panicked just like everyone else. He sold at the bottom. He watched from the sidelines as markets recovered without him. And he swore he would never let fear dictate his decisions again. The insight that changed everything for him is surprisingly simple. Market crashes caused by geopolitical uncertainty are fundamentally different from crashes caused by economic fundamentals. When a company's actual business deteriorates, sales declining, products failing, management problems, that's a reason to sell. But when a stock drops purely because traders are nervous about diplomatic talks in another country, that's often an opportunity. The underlying business hasn't changed at all. Japanese car companies will still sell cars tomorrow. Japanese electronics firms will still make products. The yen will still function. What's changed is just the mood, the temporary sentiment of the market. And moods, unlike business fundamentals, can reverse very quickly. So what exactly does Tanaka-san do differently when headlines turn ugly? First, he separates signal from noise. Not every scary headline actually matters. The US-Iran talks failing is significant because it directly affects oil supply chains that Japan depends on. But a political scandal in some distant country or a celebrity CEO saying something controversial, that's noise. Markets might react briefly, but the effect doesn't last. Second, he maintains a watch list. Months before any crash happens, Tanaka-san has already identified companies with strong fundamentals that he'd love to own at lower prices. When panic selling creates those lower prices, he doesn't have to think. He doesn't have to research in the heat of the moment. He simply executes a plan he made when he was calm and rational. Third, he sizes his positions carefully. He never bets everything on any single idea. Even when he's confident that a sell-off is overdone, he acknowledges that he might be wrong. Uncertainty is the nature of markets. Anyone who claims to know exactly what will happen is either lying or delusional. Finally, and perhaps most importantly, he's patient. Tanaka-san doesn't expect his Monday purchases to turn profitable by Tuesday. He's thinking in months and years, not hours and days. This psychological time frame makes temporary volatility almost meaningless to him. 2 weeks after that brutal Monday, something predictable happened. The panic faded. Oil prices stabilized. And the Nikkei began recovering, as it almost always does after sentiment-driven sell-offs. The companies Tanaka-san bought during the crash didn't suddenly become better businesses. They were always good businesses. The market just finally remembered that fact once the fear subsided. For retail investors who panic sold at the bottom, the math was brutal. They locked in real losses that they'll never recover. Selling a stock that's down 15% and then watching it recover means you actually lost 15%. It's not a paper loss anymore. Meanwhile, those who held steady or even bought during the dip found themselves ahead. This outcome isn't unusual. Study after study shows that the biggest gains in stock market history tend to happen in short bursts, often right after major sell-offs. Investors who miss those recovery days because they've fled to the sidelines frequently underperform the market over time. The irony is cruel. The more actively you try to avoid losses by timing the market, the more likely you are to miss the gains that create long-term wealth. Tanaka-san's calm Monday turned into a very profitable month. Not because he's a genius. Not because he has information others don't. Simply because he's learned to control the one thing most investors can't: his own emotional response to scary headlines. So here's the question for you. The next time Japan's market drops 400 points, and there will be a next time, there always is, what will you do? Will you be the investor who checks their phone, sees red numbers, and immediately starts selling because the headlines sound terrifying? Or will you be the one who pauses, asks what's actually happening, and recognizes the difference between temporary fear and genuine fundamental change? You don't need to be a professional trader like Tanaka-san to apply these lessons. You just need to understand a few key principles. Japan's economy is deeply connected to global energy markets, making it vulnerable to geopolitical shocks that have nothing to do with Japanese companies themselves. Most market crashes triggered by headline news recover faster than crashes triggered by actual economic problems. And perhaps most importantly, the moment when you feel most afraid is often the moment when opportunities are greatest. The next US-Iran negotiation, the next OPEC meeting, the next unexpected crisis, it's coming. The question isn't whether markets will panic again. They will. The question is whether you'll be prepared to think clearly when everyone else is thinking emotionally. If you found this analysis helpful, subscribe for more insights on Japanese business and economics. And remember, in markets, the crowd is often wrong at exactly the wrong moment.